All right, guys. Good morning. Good morning. Welcome aboard to the Morning Note. My name is Carlos Garcia, founder and CEO of GAR Capital. Thanks so much for taking the time out of your day to join me this morning and every morning at 9 a.m. Eastern Standard Time here on the YouTube channel. Let's go ahead and get started on the day. Dow futures down 224 points off its lows this morning. Nasdaq down about 80. S&P what are they at now? 3863 down about 0.69%. Russell 2000 down about 0.70%. So the Dow is leading equities lower in terms of the comparison of the indices. Crude oil was down 3.3%, just bounced a little bit right now around the 82 level. We're trading around 82.33 right now, down about 2.77%. Gasoline continues to fall. Again, it's still a demand issue. Bubble popped in energy and the commodities that we had, $2.36. So expect lower gas prices. Again, that's a good thing. I'm trying to find some kind of silver lining here on a bloody red day. $2.36 a gallon natural gas, up about 0.17%. Gold, even with equities falling, gold being down, that's important because of the dollar. So let's go and bring up gold. That's something that I've been talking about now on the weekly chart for a couple of videos now. Again, right at a key Fibonacci level, we're right at that support. So again, I'm not the biggest gold bug. I don't like gold that much. But if you're someone that does collect precious metals, this is probably a really great time to buy here in terms of at least the weekly chart. Again, top to bottom, Fibonacci levels on a weekly basis. Again, you're talking about since really the highs that we had last July 20, we had the July 2020 highs, obviously through COVID. But again, we're not seeing gold become that kind of safe haven here. Right now, the dollar is that safe haven since the gold priced in dollars is actually outperforming gold price in euros, gold price in yen, gold price in British pounds, obviously. So again, it is the currency, the dollar itself, that is the key. So again, if you're looking at gold here, maybe for a possible swing in terms of futures, maybe wait a little bit, at least for the Fed when they raise rates on Wednesday, see where the dollar reacts. Again, we either about 75 basis points or 100 now. So it's about 25% chance of a 100 basis point hike. And then you have the 75% chance of 75. So I don't think a 50 is on the plate, maybe a very small chance. I highly doubt it. It looks like the Fed is just going to rip the bandage, and that's something they should have done. Obviously, it wasn't transitory. Hell, I was in that camp thinking it was transitory. Technically, it was in the summer months, but have we hit peak inflation? The data seems to say so. But again, the market is now just looking at pricing in really this bond bloodbath that we're having. So let's go ahead and bring up bonds this morning. This is the 10-year yield, and you could see a little bit off the top here. Now, we hit some resistance, at least on the weekly chart, of right around 3.5%. The scary thing here is the 2-year bonds. I don't have that chart here. I have it on Bloomberg. Let me see if I can bring up a 2-year yield here. Let's go ahead and bring this up on CNBC. And again, I didn't log into Bloomberg on the computer this morning since I'm going to the office after I'm done here, but 3.927. And I went ahead and posted that information on Twitter this morning and on Instagram. Take a look. I wrote that Coca-Cola trading at a 2.96% dividend yield, and we could check that together, guys. This is the return year to date. Coca-Cola, again, pretty safe stock. Again, high dividend payer, dividend aristocrat, everything. It's only up 0.56% year to date. Energy killing it, obviously. But take a look here at the dividend yield. Again, you can get a 4%, pretty close to it, 3.927% for 2 years on the actual 2-year bond, or you could just buy Coca-Cola itself. So again, that's the problem now with stocks, is that how are we going to price in and adjust our risk based on higher rates? So again, if I'm going to get higher interest rates in the bond market, government bonds, 100% safe, they print their own money. This is where this is where companies need to raise dividends, and this is more money off their balance sheet. Ask AT&T and Verizon how much paying dividends is hurting their stock. Let's take a look at that. I want to show you that for a second. Let's take a look here. Right here, AT&T paying a 6.63% yield, 6.33% yield for Verizon. Sounds great, right? Hey, Carlos, it's beating the 10-year, it's beating the 2-year. That's great. I'm making some money off that. But take a look at the year-to-date performance just on the stock, on the equity holdings. Down 20% on Verizon, down 10% on AT&T. So not the best there. So again, if you're a long-term holder of Verizon or AT&T, I don't think it's a point here to want to sell immediately and jump into two-year Treasury notes. I'm not saying that at all. I'm just saying in terms of the pricing structure with the market. That's the problem with equities here, is that you have bond rates, bond yields rising so fast on a hawkish Fed. It's very difficult to price in equities because now you have to adjust it for risk. So again, there is no risk on a two-year Treasury bond. There is massive risk on equities, as we know. So again, the good news is that, like I explained that on Instagram, the silver lining here is that if we get to a point where bonds become extremely attractive, where 4.5%, 5% on a two-year basis on a Treasury bond, oh yeah, you're going to get some bids there, and then that being bought will bring down Treasury yields. That's really going to indicate some kind of bottom in the S&P. Again, we still have the seasonality approach where towards the tail end of September it gets weak, and then October, November, December we get that year-end rally. I think that's more likely going to happen. Again, I think that Treasury bonds do will peak at least, and then we'll get some kind of pivot from the Fed. Again, maybe in the next 6 months, maybe not towards the end of the year, but again, to the point where where is that bottom for the S&P in terms of levels? If you guys remember, I moved it higher from I had 3,500 where it was at 200 day on the weekly. I put it right around 3,900 where I raised it. So again, we're not at the level yet where I'm seeing any kind of stocks that are super attractive, at least on the pricing basis, because yields are just a little too high. Again, Nvidia is something that's on my watch list. Again, I have right around 120. That's number one on my list. Google, again, right around 97. I have a TQQ position I want to add to 1823. So again, it's bad out there, but it's not bad enough to want to go ahead and put capital where you can get at least somewhat of a decent, safer rate right now. So that's really what you're fighting right now if you're an investor or at least a swing trader or a short-term investor that's just looking at their 401k. If you are looking at your 401k and you're in your 20s, 30s, or 40s, none of this really matters. You're just doing dollar cost averaging and you're getting the best price on the S&P anyways. Let's take a look at the dollar. And the dollar, again, very, very key. Above that trend line, we talked about that on the max setup over multi-year basis. You could see 121.02 on 2002 was our peak. I don't think we get there. Obviously, that's just my personal belief. I don't think the dollar will soar that much. But hell, we soared $19 alone just in 1 year, just on the index basis. So the problem with the dollar, it's not that the United States is some beacon of economic growth right this second. Actually, economic growth is pretty tepid, according to the Atlanta GDP Now reading. The issue at hand is that we're the best house in a bad neighborhood. Again, we talked about Europe. We talked about the British pound. We talked about the yen. We talked about the Chinese yuan. I mean, everyone else is hurting while the United States is performing better. Well, that's what happens when you're a superpower. So again, the dollar is right now pretty much the ultimate hedge. Just stay in cash. That's basically where we are. There was an interview on CNBC this morning with the CEO of Interactive Brokers. Their cash levels in terms of brokerage houses themselves, the brokerage house, cash positions for their traders, like what they have in dry powder, let's just say, and it's at all-time highs. So you're not getting a lot of people buying dips, but you definitely have some people there waiting around for an opportunity to get into equities as maybe we'll get treasury yields peaking. And what does that tell me? That we may get a really quick rally once we get that peak. That's why I'm still looking towards Q4. We probably bottom around October, right ahead of the midterm elections. Politics matter somewhat. The Fed says they're independent, but I'm pretty sure they'll pause. We won't get a rate decision in October. We'll get it in September. Maybe we get a little bit of a dovish tone saying that we're wait and see approach in November. We're not going to do automatic. That might be enough to ignite some short squeezing. So don't be surprised in October we get this kind of summer type rally like we had towards in August, towards late July into August. A lot of stuff to be said. I understand. But I really wanted to focus on the macro issue at hand that yields in the dollar, guys, been repeating it over and over. That is hurting equities. The good news, the 10-year yield at least is coming down a bit, but watch the 2-year moving forward because that trading at 4%, it really takes away any kind of want or desire to invest in equities. Coca-Cola being one of the safest, of course, we know. Dividended aristocrat. Do you want to buy that? Getting a 2.96 yield. I think that's it, 2.96 yield. Or would you rather get a 4-year, 4% on a 2-year? That's where fund managers are talking about. What we're looking at as investors today, if I just want to wrap this up, is really the fact that when do bonds become attractive enough that people are buying bonds and take advantage of those rates, and then you have better, lower rates after that, since again, bond prices and yields move inversely, and that's when we'll more likely bottom. That's really the name of the game right now that we're just waiting on. When do treasury yields peak? And the Fed on Wednesday may give us a little bit of a hint to that. Let's answer a question here. What are the next resistance level for the S&P? Big line here is 3,900. Again, you could say round number theory, whatever you want, but 3,900 was the Friday highs. We tapped that towards the tail end of the futures session. This morning is where they sold it. So Asia and Europe selling it. Let's see if the Americans, the US buys it. But 3,900, 3,889 being your Fibonacci level. But 3,900 is probably the next resistance that you're looking at. In terms of support, you do have a couple of double bottom here. We had a double bottom. So right around 37.85 is your next support, at least if you're looking at S&P 500 futures at home. We'll go ahead and place the alert there. In terms of gaps, really all the gaps are on the upside. So again, there's not much in terms of downside gaps on S&P futures, at least on the daily. Cowboys with the win. I didn't say anything, but I'm glad you did. That was a pretty decent game. I'll take it any day of the week. God, I did not want to start 0-2. Go Vikings. Hopefully the Vikings beat the Eagles. Carolina did not do their job and beat the Giants. Thanks again. But man, that Baltimore Miami game, big shout out to my friends who are Dolphin fans in Miami. Salute to you. It was a great game to watch on the red zone. The support level, again, 37.80, 37.85. QQQ call levels. Let's go ahead and take a look at it together. We're going to go ahead and stick with the 1 hour and kind of keep it short term if we're just doing calls. Again, keep in mind, right now, put premiums are going to be very expensive. So again, I'm going to keep an eye on the put call ratios today ahead of the Fed on Wednesday and see if possibly calls do become a little cheaper, or to the point that puts get so expensive that you'll just get a shift in those ratios. If you remember a week ago, I posted a chart of put call ratios being near support. And then of course, put call ratios soared because it's a ratio. So again, put call, if you have a higher number, it leans more to the put side, short. And of course, if you have a lower number, that's leaning more to the call side. On terms of QQQ, 288, it's a big level right now, at least short term. That's your 20-day on the 1 hour, 288.86. Let's call it 289 is your 50-day. Really, the 290 level would probably be the level you're looking for. We're about $2.25 away from that currently, Jason. But take a look at crude. Crude getting to 81.20. Energy stocks not that affected, which is a really good sign. I have Chevron position. There's a little bit of a gap down, but again, you can see right near support on the 1 hour. Year to date, we know that Chevron has been doing great with energy. Thoughts on NVIDIA being down pre-market? Yep, I do have calls. Let's see what happens this morning. Again, it definitely could be bid this morning. It is holding up support of the 50-day. At least that it's not doing as bad as the broader market. Nasdaq itself, kind of in line, doing in line with the S&P at the current moment. So we will see where we're at. It's been tough sledding, but we'll see if we could bounce back. Again, my eyes are on the macro, the dollar, and yields. Any updates will be on Twitter. As always, make sure to follow us. Very, very important to follow us for all news. Nick has the market blog on Discord. Have a great rest of your morning. Go Cowboys. Victory Monday. We will see you tomorrow at 9 a.m. Eastern Standard Time. Cheers, guys.